Hi, folks. This is Hyman from the Logical Investor, and I want to talk to you about bubbles and parabolic moves and how to spot them and things of that sort. The best way to do that is not looking at the short term. The best way to do that is looking at longer range charts, weekly charts that go back multiple years. So I went back to show one bubble here. This is the NASDAQ chart. Back in 2000, pretty much everybody remembers the tech bubble, tech and internet bubble, with AOL come crashing down and so many others, Qualcomm and many others. And pretty much anything that was tech company, internet company, or anything that had a .com on the end of it got caught up in this huge push higher, and people thought, this is they always make excuses for bubbles. This is the new economy was the buzzword, and quote, in the new economy, you didn't have to have earnings, and PEs didn't matter anymore, and there was all kinds of nonsense that was in that. And of course, Warren Buffett dodged it, and he was ridiculed for not being in on it. But what he's really dodging is, so yes, it's fun and exciting when this is happening, these moves that seem to go just straight up. But the problem is nobody knows exactly when they're at their top, because they're at their it's an emotional, illogical move to begin with. Now there's Elliott wave counts that we can count in it, 1, 2, 3, 4, and then here's 5, which was extended. But you still don't know where the exact end is, even in 5, and there's 5 waves in the 5th wave, but it's still hard to call that final push. And this was way out of whack when it was at 3,200, 3,700, etc., and it goes to 5,132 before it tops out. But what you avoid when you avoid these parabolic moves and bubbles is you avoid the crashes that come afterwards. So nobody knows when this exact reversal is going to happen, but they all come. And the problem is that when the downtrend comes, for starters, usually everybody thinks this first pullback that scares people is really just a pullback within the uptrend, and that the uptrend will resume and continue to go ever higher, because they are just conditioned to believe what recent history has conditioned them to believe, which is that, hey, this thing's going up, it can't go down. Almost every day is an up day. I mean, just throw a dart and you hit something, and it goes up. So these are the times when people want to tell their boss where they can stick it, and they want to just sit home and trade, and they think they're geniuses and investment gurus and all sorts of things, and all they're in is just a frothy market. And these things turn around when they're at the peak of the euphoria, and they have a massive downtrend. And the thing about the downtrend is it wipes out most all of the uptrend, especially when most people have got into it, because when most people are into it, it's not here where it's not exciting. It's not even here where it's a typical trend. It's when it starts to pick up steam towards the end of wave 3s or wave 5. And so a lot of people are in it here, but the thing ends up going back all the way down to here. So who would have thought they would go from, the index would go on the NASDAQ from 5132 down to 1108 before it finally halts. And that took, like 2.5, almost 3 years to happen. So these bear market trends can take some time. And then when they get down here, since this has been happening for 2 or 3 years, all they can see is a down market and another market that will never turn around and go back up again. But then it'll, finally, after some years of going down in the bubble, it went from 1100 to what is that, 2861 over the next, what is that, 4 years or something like that. So, and then we, have a massive pullback again, because remember, and this is coming into 2008. So PEs were super high in 2008. They were super high in 2000. And guess what? They're super high right now. So, and one way that so this is not a parabolic move, but this just becomes an overvalued move, and it has a massive correction. This is a parabolic move in a bubble, and it has a crash, and it's massive. And one of the ways that you can spot bubbles is when you're looking at multi-year charts, at least 5 years back, looking 10 years back or more is even better. When the move starts to, seem like move straight up and pull unusually far away from the 200-week moving average, which is this red line, then you know that you're in a parabolic move, an irrational move, a euphoric move, and sometimes a bubble, and that's going to pull back towards the moving average and then some. And the further it stretches away to the upside, typically the further it overshoots to the downside, like a rubber band snapping back. So here PE valuations were high in 2007. It wasn't a parabolic move. It wasn't a bubble, but it was an overvalued move that was far away from the 200-week moving average. And what does it do? It pulls back to it and then some. And then here we get to a state of undervaluation once again with low PEs and the height of negative sentiment and pessimism around 2000 at 1265. And who would have thought at that point that you would see the likes of 6341 on the composite. So, but these moves that get far away from the moving average, each time that happens, like early on in the trend, it just pretty much pulls back to it and keeps going up. But when you get to the fifth wave, that's when you're going to have one of these A, B, C's. Here's the fifth wave. Here's your A, B, C downtrend. So we've gone 1, 2, 3, 4, and then we're in the fifth wave now, which is the irrational time, the euphoric time, the time when people get lax and lazy about their stock portfolios, when they can't see a day when it would ever go down, where they think you're the idiot for ever even insinuating that the stocks would go down. And they'll rationalize all the reasons why that you're the idiot and you're wrong, even though you're the professional. You've been doing it for 20-something years, and they're just a armchair investor that works a day job as an employee or a small business owner, and then plays stocks, so to speak, in their spare time. But yet, they're the pro. So they get really a kind of an ego and a haughtiness about them, and their ears get plugged up, and they can't hear anybody else. Their head gets inflated towards the tops of these wave fives. And here we are again, very far stretched, not only from the 50-week moving average, but also the 200-week moving average. And since we're at the end of wave 5, we're going to see a big ABC come. And so, it would not surprise me if this index cuts in half from here. That's very, very easily done. I mean, this wasn't even a bubble per se. It was just an overvalued market. This was a bubble, where it's going up parabolic straight up move. This was just an overvalued market here in 08. And it went from 2861 down to 1265. So, you could see, and then here it goes from 5132 to 1108. So you could easily see where this could go from 6341 down to 3000 or so, and still, before it gets to where it's a decent value. Okay, so let's take a look at, let's see, I will take you to the Shanghai Composite Index. Probably more of you probably followed this on the news back in 2007 and 8. Then, because it's not like people hardly outside China were able to invest. I mean, some large institutions were, but the average mom and pop, regular everyday investor was not. But so I remember when this was happening. Again, a parabolic move. The Shanghai Composite Index went from 998 up to 6124. When this was happening, even a fellow course instructor that I was course instructing with. So this is a guy that's got some experience and things of that sort. And he was an Asian guy that had a background in China. When this was going on, he was saying, "Oh no, this time it's different," and you don't know China and it's different, and the Chinese government can control these things, and so therefore it's not a bubble, and they'll let it down easy. And I said it's never different, whatever the asset is. I don't care if it was Beanie Babies or Cabbage Patch Dolls back in the day, or tulip bulbs, or if it's internet and tech stocks, or if it's Chinese stocks, all asset bubbles pop and they come back down. Here's your A, B, C. C is typically the longest wave, not always, but typically. And this goes from 61.24 back down to 16.64 before it stops. So again, it retraced the bulk of the gains. And when do most people get into it? No sooner than the halfway point. Usually more about 2/3, 3/4 of the way on up is when the average person in the public would get involved. So other things that you can tell where there's bubbles is that people that just aren't normally in them get in them at those times. There were people that were just going to Chinese stock brokerage houses and just watching the stock quotes all day long, and housewives that were going up there and monitoring stocks and trading positions and things of that sort. And just, again, people that just normally that would not be their world, that would not be what they would have exposure to and experience in. They're all sucked in at that point. So the old Wall Street adage would say, when the shoeshine boys and the taxi cab drivers start talking about stocks, you're in your latter phases of a bull market, and you better start looking for exits, because when what they call the dumb money, which are the inexperienced, are getting in, that's a telltale sign that you're in the latter stages of that euphoric move, and you need to be looking for exits, even if you don't catch the top, because the downfall is fierce. So China actually had a couple of bubbles. So this was their biggest one back in 2007 and 8. But then they had another one, and I warned about every single one of these bubbles ahead of time. I warned about NASDAQ, the NASDAQ bubble, and I got my dad out of that before things went south in his 401k, and we dodged that. And I had to do a lot of talking to him because, once again, it's easy to buy into. Quote, everybody's seeing their mutual fund portfolio go up. Everybody's seeing their 401k, their IRA go up. Even though they know things are bad out there, for some reason their account balances keep increasing. So and they get greedy, and they're afraid they're going to miss out on something. So you can't get them to pull the trigger and get out. And they don't even know why it's going up. And nor do they care. They just care about their pockets getting deeper. And but the problem is this happens and this happens. And so when this one happened, the Chinese stock market went from 2,000 to 5178, and then when it crashed, it had its ABC and went back down to 2638 before it was all said and done. So that's an example of another couple of bubbles. And then sometimes you've got assets that just get way ahead of themselves, way out of hand. So this really is a parabolic move and somewhat of a bubble itself, but for sure you can say it definitely gets out of hand when it gets way away from its 200-week moving average. You can see the price typically just it gets a little above it, and then it pulls back, a little above it, pulls back. But when it goes massively above it, you can tell that emotion has taken charge, that there's a euphoria, that there's a lot of irrational thoughts, that sound logic has gone out the window. And you don't even, just by seeing this, you don't even have to look at a fundamental at all to know that this is happening. But PEs will be ultra high, and I'm not discouraging the looking at fundamentals. They are the first and foremost thing you want to look at. But in spotting parabolic moves and bubbles, this technicals and charts on long range charts that go back multiple years show you a lot. And so this is the IBB, the iShares NASDAQ Biotech ETF. And it went from basically 400 at 399.38 down to 239.21. So, and it did that in a very short amount of time. What was that? Just mere months, because this happened just after the first of 2016, and this was mid 2015. So, in 6 or 7 months, this came close to cutting in half. Other great stocks that have gotten ahead of themselves. Let me spell it right. So Apple, I have had my subscribers out of Apple anytime the price was way away from this 200-week moving average, which is like here, 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 etc. We weren't back in it on this one, but I would have spotted that one as well because it's the same dynamic. And we get in, we got in several times when the price was closer to the moving average. So as you can imagine, when you're at these points and the price jumps up very quickly way away from its 200-week moving average, which is what's historically out of line with what's the norm, there's a euphoria. The news headlines are just super optimistic. So they're saying Apple can do no wrong. They own the market. Back when Steve Jobs was alive, he's the master, he's the man, so forth. Then when these things happen and they go from, this is split adjusted, but 91 to 50, down here, Apple becomes a has-been company. Samsung's going to own the market. They get bashed. And so the sentiment's uberly bearish. But this is, a time to be in it. Then it comes back to here. It goes from 50 to 128, and, Apple's back to being everything and just can do no wrong, and everybody and their mama wants to own it right in here. And then it comes back, to here. So it goes from 128 back to 88. And so forth, and so even good stocks can get way ahead of themselves, and when they go up so far so fast that they get way away from this 200-week moving average, overly stretched, you can tell that that things are getting out of whack. So I've said all that to say this: the latest bubble, and I'll probably have to shrink this chart down some to get it within your view. Well, I want it to go real small, it looks like, to get it within your view. I think this is still within your view. So I got to get it real small. But anyway, so this was Bitcoin, its first bubble, which happened, I believe it was, let me blow this back up, 2014. So this goes to 1,200. And by the time it comes back down, it's down to 200. So that's its parabolic move up, its first one, and then its crash. Now we're in another one where it went from 1,000, 2,000, 3,000, and we're going to see another big crash that will probably bring it down into the hundreds, not the thousands. And again, they always say, well, this is a different asset, and this is a different situation, and there's different supply to demand dynamics, and this is the future innovation, blah, blah, blah. They've always got their reasons why, and I hate it that this chart is so small. I wish I could make it bigger for you. I don't know if I can. Let me play with something here real quick. Just see. Well, it's not going to let me separate it out. Don't know why it won't. But anyway, so this has gone, up to near 3,000, and it's temporarily gone under 2,000 within about a month and a half. So it's lost a third of its value in just probably 40, 45 short days. And it's bounced up, just a little bit the day of this recording, not much, but a little bit more. But this will have a massive crash too. This might even be in the A move of its downtrend. It's too early to say yet, because you can't say you're at the exact top of any parabolic, irrational, illogical move. But this is going to have a massive crash too. I predicted this one. I went on to Fox Business and talked about this crash, and came close to calling it to the day. But I can't claim that I can do that all the time. Nobody can. So I want to make that clear. But it was just getting way out of hand, and it goes from 1,200 to 200, and nobody would have expected that. And these crashes go a long ways down. They take a while to work themselves out, and this will be no different, this time. So no matter what the asset, parabolic moves and bubbles you can spot by looking at weekly charts going back multiple years in time. You can look and see how far the price is away from the 200-week moving average. You can look at the steep upward angle, and all of that will help tell you the euphoria, the irrationality, the illogical type of things that are happening out there. And another telltale sign is that inexperienced people always come in towards the tail end of that thing. Right now, when I'm looking at Bitcoin and any other cryptocurrency, I mean, there's people that are even my subscribers that are sucked into it. Not many, thankfully, most of them listened. But there's a few of my former subscribers that they think that they're right this time and I'm wrong this time, and that that's fine. But they're going to get burned and lose a lot of money in that because they're just inexperienced and they don't listen to the voice of experience. And I've got some subscribers in Australia, and they're talking and yakking it up right now about cryptocurrency and how they're going to make all this money and they're going to retire their spouse and all this kind of stuff. And now, granted, these are people who've never had experience with the currency market ever. They've never owned any currency outside of their home currency. They don't hold a portfolio of foreign currencies. They've never traded in the Forex market successfully, but yet all of a sudden they're a currency expert, and so they're a cryptocurrency expert. They've read a few web pages and they got caught up in the hype, and now they're an expert. So these bubbles, they are. They suck people in, and so you've got to look at them logically. You got to be able to spot them. You got to be able to measure them. And one way that you can do that is counting Elliott waves. Another way is just looking at how unreasonably far they are away from 200-week moving averages, and look for those parabolic moves in particular. So even something that's a great asset can be a great asset at a wrong price. I mean, housing in 2007 and 8 was just as good a bricks and mortar, just as good a foundation, just as good a roof, just as good a neighborhood as it was 2 years previous. But what had happened was the valuation of that asset had gotten so out of whack that in some markets in the United States, values fell by 30 to 50%. I think one of them was even 60% and fell below even the cost of a builder to build, the building costs for the homes, and that was in Las Vegas, Nevada. So it doesn't matter if it's housing, if it's stocks, if it's cryptocurrency, if it's Beanie Babies or Cabbage Patch Dolls or tulip bulbs, and some of you that are a little bit older will know some of those others that I've named, and others you may have to Google it. But prices of all those things just went nuts. And they all went parabolic, and some of them, of course, you don't really have the ability to chart unless you were, charting them on a spreadsheet or something like that. But they all got into asset bubbles. Some of them aren't even, it's hard to even call them an asset. I really don't consider cryptocurrency an asset, in my opinion. Anything that can lose a third of its value in a month, I would rather hold dollars than cryptocurrency. And if you Google the stories and find out about how often cryptocurrencies of all kinds are stolen, and they're untraceable, so they can't, even the FBI and other groups can't even go and find out where the money went to. And when you find out that hackers and thieves love cryptocurrency, then it's just another reason to stay away from it. But this is the latest shiny object that everybody's chasing, and I say everybody, it's the dumb money that's chasing it. But so just know it's in a bubble, and it will pop as well. And that's the reason why I'm giving you this video at this point in time. But I also just want you to, in general, know how to spot bubbles and how to spot even good assets that are far out of valuations of what they should be. So even if you're wanting to say, I want to get into Apple stock, when the price is way away from this moving average, you know that there's going to come a point in time where this is going to snap back towards this moving average and then some. Now, of course, when you get to the end of wave 5, you're going to have this massive ABC. It's going to go way below that moving average. But just in the earlier on in the uptrend, you definitely, since you know that that's the habit, it doesn't have to come all the way back to and touch the moving average, but it has to come back into that region. So knowing that, why would you want to buy it at 91 when you know it's at least going to come back to 70 or 60 or something like that, and it ended up coming back to 50? Why buy it at 128 when you know that it could come back to 110 or 100 very easily, and it goes back to 88? So, and it's also the reason why I'm big in averaging in. So, when something pulls back, and of course you're not going to know where the exact bottom is, put in a third, and if it falls significantly more, put in another third. If it were to fall significantly more, put in another third. And that way your average break-even price is much better, and then you get back to break-even quicker, you get profitable quicker, and your overall return is even better as well. So I love that averaging in approach. It's the way Warren Buffett does. It's the way many institutional investors do. Your average retail investor just goes all in. They buy all the shares they want right there at that moment, however many shares they can buy. They can buy 1,000 shares, they buy them all at one time, and it's not really the best way to do that. And, some people go, well, yeah, but if I break it up over 2 or 3 orders, then that's 2 or 3 commissions. Well, I'm telling you, you would rather pay the $7 or $9 or $10 commission each time and, get a price that's going to be far better, that's going to make you, hundreds or thousands more in profit. So you don't want to scrutinize nickels and dimes on your way to dollars. So the bigger thing is that you want to look at is you want to think about the long-term return, the average break-even price, and the commission cost for the investor really shouldn't be a thought. I mean, you want to be with a discount broker, Ameritrade.com, Schwab.com, Fidelity.com, whatever, ScottTrade.com. I mean, there's a bunch of good ones out there, but aside from that, you don't want to worry about commissions. You want to focus on your average break-even price, getting as low as possible, and then having the patience to ride it up. And one way that you can know to exit assets is when they're moving up and they're getting far away from this moving average. You can start peeling off, sell half, and then if it goes up quite a bit more, sell another half or something, and get an average higher selling price. But know when the price is getting way away from the moving average. It's a great time to exit an asset as well. So there's a lot of things that just the charts alone can tell you. Again, if you follow my videos, you're going to know that fundamentals are the first and foremost, because they tell you the quality, whether a company is like a fortress or whether it is like a little paper cup or something, as far as its stability. So fundamentals are first and foremost. They give you the confidence when things are going up and down, and they also tell you whether you should be in an asset to begin with. There are some things that go up that they don't make money, so I don't get into them. And people go, yeah, but they're going up. I go, so what? Because an investor doesn't become a speculator just because something happens to be going up, because they're not going to be able to have confidence in it when it might start to turn down. And when it starts to turn down, how are they going to know how to value it when it didn't really have any good value in the first place because it didn't earn any money? So you can't, there's a big difference in being speculator minded and investor minded, and you got to choose and decide which one you're going to be, and you got to stick to it, and don't be drawn away by the flashy, shiny objects that come along, because they're going to come along, and the asset will change. In 2007 and 8, everybody and their mom, it seemed like, was fixing up houses and flipping them and buying a second house and buying another condo and this and that and the other, and a lot of them got caught holding the bag because they didn't ever see a day where the top would ever come. Because after all, the last so many years had told them that these things are just going to go up, 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 up. And they say, well, I got a real asset. And, real estate, after all, never really goes down. And a lot of nonsense like that. But it does. There are periods where real estate can go down when it's in a bubble type period. Now, over long periods of time, 10, 20, 30-year period of time, yeah, it's going up over that time. But it goes up and down and fluctuates quite regularly. So, but anyway, you get my point. So when assets are in bubbles, they're easily spottable. You don't have to get sucked into the emotion of it. You can stay rational and logical about it. You can measure things. You can count things. Looking at the Elliott waves, etc. But the biggest thing that anybody can do, because all these things are pre-calculated for you, is look at how far the 200-week moving average is, which that's just a 200-period simple moving average on a weekly chart. how far that moving average is away from the price. And if the price has gotten way away from that moving average, you know that there's a huge chance that it's coming back down. And so if you own it and it's way over here, you probably want to be looking to get rid of it. Now, as I'm closing, let me go to like a 10-year chart so I can kind of zoom in here just a little bit, and let me show you some stocks that are crazy valuations right now from the charts. Look at Facebook's price right here, and look at how far back the 200-week moving average is. Amazon's another one. You know, every day it seems like Amazon has a new headline and how they're taking over the world and how they're going to put another company out of business and blah, blah, blah. But keep in mind, the news always gets overly positive near tops. And where's the price of Amazon right now? And where's the 200-week moving average? Way back down here. Notice what happens each of those times when it gets away from it. And this is the furthest it's been in the last decade. So and remember when I said they pull way away, they're likely to shoot way over to the downside. So this is over 1,000 today, but 2-3 years from now it could be 300 or 400, and it could go there over the next 2 to 3 years. Netflix is another one. I'm going through what they call the FANG stocks: Facebook, Amazon, Netflix, Google. Netflix has been up here, 166, 161. The 200-week moving average is back at 90. Google, it's not quite as bad, but it's still very far away. 1,008, and this is back at 675. So, and any asset can do it. Even great. Actually, silver's an even better one than gold. Silver, started going parabolic, and it went from 18 to 20 to to 30 to 40 to almost 50 in a little amount of time. I mean, just in 2010 and early 2011 alone, it went from 14 to 49.82. So this parabolic move up, and people are, silver's real money, and silver can't go down, and it always holds its purchasing power, and blah blah blah. And those are general basic truths that are true. However, when it gets in a bubble, it's still going to pop, and it's still going to come crashing back down. And so it goes from 49.82, and you have your ABC, and it doesn't stop till it gets down to 13.62. So now it's starting to turn around again and head back up, but it took years for that bubble to completely pop and fizzle out. So this was happening in early 2011, and it bottoms in latter 2015. So and now it's turned around and getting ready to head back up again, but again, we're still at the ultimate pessimism right here towards these lows right here and here. So nobody's thinking it could go back up again, but it will. And gold did the same thing. It went from 600s to 1900s and got way ahead of itself, and it was way up here, and the moving average was here. And again, I'm bullish generally on gold and silver, but not any time and at any price. And that's why I'm not a gold bug, because I don't believe any day is a day to own gold. I was warning against gold and silver for once when it was up in these levels on both of them. And here's your ABC correction, and it goes from 1900s to 1045 before it halts. And now we're in the turnaround, or it's starting to turn around and getting ready to head back up again. And of course, quote unquote, nobody thinks that that's going to go back up again, because we're at the height of pessimism in gold towards the end of wave C and the bottom of wave 2, just like you're at the height of maximum optimism at the end of wave 5 right there. So anyway, avoid bubbles. Every asset can get into a bubble, and no asset is immune to it. You see them in gold and silver and real estate. You've seen them in stocks. You've seen them now in cryptocurrency. So don't be fooled. That's the lesson. Okay, thanks so much for watching, and God bless. Bye.